Welcome back. I'm Peter St. Honest. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. The Federal Reserve just announced it's unleashing the money printers to finance a $9 trillion wall of federal debt coming due this year. As in, markets won't buy it, so the Fed will with counterfeit money. This is where the Fed types zeros on Excel sheets in the basement, declares their dollars like any good counterfeiter, then uses those fake dollars to buy government debt called quantitative easing or QE. Jerome Powell said the Fed's kicking off with $40 billion a month, which is $500 billion per year, lovingly printed straight out of your wallet. Now, this is concerning, because the last time the Fed did this, in the 1940s, to finance World War II, it sent inflation into the double digits. At one point in 1947, annual inflation was 20%. In fact, it's how Weimar Germany got to hyperinflation and wheelbarrows of money, because once the central bank starts printing the deficit with inflation, it's very tempting to make that deficit very big. After all, there's a lot of special interests to feed in Washington, $1 trillion here, $1 trillion there. Soon it is real money. What's even more concerning is that in the 1940s, it was just about financing government debt. Today, the Fed needs to pump hundreds of billions just to sustain a financial sector that has ballooned to nearly 5 times GDP. The Fed literally admitted this, with Jerome Powell claiming that this is not real QE, which everybody knows is inflationary. This, in fact, is necessary to maintain, quote, ample reserves so the Fed can maintain control of interest rates. In other words, the financial system breaks unless the Fed keeps a full plate of cocaine or inflation by the bar. The Fed knows this because markets cracked both times the Fed tried draining QE. There was the so-called taper tantrum in 2013 and then another one again in 2019, just before COVID, when interbank rates spiked to double digits. In both cases, the Fed got back to printing toot sweet, bringing us to so far $5.5 trillion of freshly printed QE since the 2008 crisis, which is almost as many dollars as existed in 2008. So as next, in a recent video, I warned we are entering fiscal dominance, where the central bank ignores inflation and jobs and only focuses on financing the government, which is very inflationary. The Fed just confirmed this to the tune of $500 billion per year, maybe $1 trillion if markets make it weird. In a few short months, we get a new Fed chair with prediction market Kalshi fingering Trump's chief economist Kevin Hassett. Hassett has been very forthright about wanting lower rates, which is good for jobs but bad for inflation, even though inflation is already stuck at 3%. And markets have long seen Hassett as the QE guy. So short term, the Fed's now fully reverted to the inflation factory it was born to be, inflation that will drive voters in the midterm election. Long term, if federal deficits keep getting worse, which they will, we are now on the road to permanent double-digit inflation. The European Union just fined Elon Musk $150 million for free speech and an escalation of its war against democracy and America. Politico calls it a, quote, lit fuse in a new Cold War between America and Europe. Last week, the European Commission, which oddly enough has never won an election despite allegedly being a democracy, slapped a $150 million fine on X. Their excuse was the blue check policy on X, which they claim is opaque, which is goofy considering anybody who's verified gets a blue check, verification being by credit card, at $8 a month. Now, whether or not you like $8 a month, this is not opaque. It's very transparent compared to the old Twitter that used blue checks as political litmus tests. I can vouch for this. I was on TV almost daily, but Twitter would not give me a blue check until Elon bought them and made it transparent. The EU, of course, had no problem with the old litmus test since it was built on censorship. So the background here is the EU has been at war with free speech, with almost 20,000 regular people arrested for anti-left tweets across Europe. Most U.S. tech companies caved, as did the single European platform Telegram after France arrested their CEO. But Elon did not, making him public enemy number one for Europe's unelected authoritarians. Well, they also hate Trump, but they can't go after him since he controls the hundreds of billions American taxpayers pay to protect Europe from their own wars. The reason they go after Elon, of course, is censorship is existential for Europe's ruling caste, which polls showing every major European country going populist in the face of the EU's economy-destroying regulation and green mandates, along with their society-destroying mass migration. In other videos, I've mentioned the clown show of European regulations that run 2 to 3 times the regulatory burden in the U.S., which is already high. To give a flavor, you have to get written permission to have a birthday party for an employee in Germany. Energy costs are 2 to 3 times U.S. levels, to the point the fabled German car industry is imploding, taking hundreds of thousands of jobs with it. On migration, Europe is now taking in 5 to 10 times more migrants than births to native Europeans, meaning they are on track to become a minority in their own countries, then a rounding error in their own countries. And so the EU is doing what every socialist regime does in the endgame: shut up the people, then start a war for emergency powers. Less than 8 EU countries have moved to reinstate the military draft, including France, Poland, Italy, and ominously Germany. So as next, J.D. Vance already criticized the fine, calling it, accurately, a censorship shakedown. Trump, meanwhile, came down hard on similar moves by Canada and the EU itself to squeeze American companies with taxes and fines. They have backed down every time when it was just tax, but on censorship, the EU might not back down even at the risk of a suicidal trade war, because they know that free speech would wipe them out. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold, paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. Now back to our show. The pain continues for China with another massive Chinese property developer crashing, shattering what little confidence remains in China's housing market. Now, this matters because housing is almost a third of China's economy. That's twice the U.S. In fact, housing in China is almost as big as exports, meaning if housing crashes while exports are in a trade war, there is not much left. Despite trillions in government stimulus, retail sales are slowing, industrial production growth is flat, and investment is actually falling as foreign investors flee China. The failed developer is China Vanke, which has $51 billion of debt. Actually, some estimates peg it at twice that. Nobody really knows. They just asked for a delay on bond payment, essentially a default, crashing their debt to 20 cents on the dollar. The problem is Vanke was supposedly a safe state-backed developer, raising questions about the other $3 trillion of developer debt in China. More important, what this does to China's housing market, which accounts for nearly 3/4 of household wealth in China, and last month house prices fell by an annualized 5%. China's already reeling from Trump's tariff wars. They export about a fifth of their GDP, about $3.5 trillion, which is also about twice what exports are for America. And even before the Trump tariffs, exports had fallen 14.5% year-on-year at one point, the worst crash since COVID. Now, they've held up under Trump's tariffs only because of dumping in Europe and the Third World, which is already getting pushback, including Europe slapping tariffs up to 35% on EVs, Turkey putting 40% on Chinese cars, and Mexico putting up to 50% tariffs on a range of Chinese imports. Now, China's seen this movie before, back in their 2018 trade war with Trump, but back then, housing picked up the slack, absorbing almost $2 trillion a year. Not this time. House sales have collapsed 40% from the peak. The property sector already lost $3 trillion in value. Two massive developers, Country Garden and Evergreen, imploded recently, laying off 400,000 workers. Meanwhile, foreign investment in China collapsed to a 25-year low as companies quit the country, many of them moving to the U.S. to get under Trump's big, beautiful tariff umbrella. Finally, China's local governments are swimming in debt the IMF estimates at $12 trillion, wasted to artificially goose GDP numbers, things like rebuilding the bus shelter 2 or 3 times, or thousands of miles of roads and bridges to nowhere. Some provinces now spend 2/3 of revenue on interest payments alone, and total government debt in China is probably over 200% of GDP, which would be roughly $50 trillion in U.S. terms. In short, between property, foreign investment, and government debt, China does not have the trade war buffer it had last time. Trump is cutting into muscle. To illustrate, China's youth unemployment rate is already soaring. When the companies in trouble, they cut the young first. The government actually stopped reporting youth unemployment once it hit a record 21%, but private estimates peg it closer to 30%. Professor Zhang Dandan of Peking University puts it at 46%. Note, this is a country where 11 million students graduate every year. That is a tinderbox. So as such, under President Xi, the Chinese miracle has become a bloated capital hole sustained by eye-watering debts while dumping cheap exports built on below-market government loans. China's putting on a brave face and spending trillions of stimulus to hide the pain, but with 30% or 46% youth unemployment, Trump could tip them over the edge. A new study finds just 1 in 8 college grads have a job by graduation. That used to be almost half. Almost makes you think maybe we don't need to import tens of millions of third-worlders to fill jobs. The number comes from CareerPlannerIntelligent.com, who reports just 12% of Gen Z college graduates have secured full-time employment by graduation, while 58% are still looking for work, making do with hourly gigs at Home Depot or living in mom's basement playing League of Legends. For comparison, almost half of millennials and Gen X had a job by graduation. In fact, according to the Bureau of Labor Statistics, the unemployment rate for 20 to 24-year-olds is now almost 10%, the worst since the molasses speed recovery after the 2008 crisis. More ominously, the unemployment rate is now identical for young people with college degrees and high school degrees. A year ago, it was a third worse for high schoolers. In other words, the 150,000 degree is now zero protection. Intelligent blames AI taking entry-level cubicle jobs, but a big part is also the hiring binge in 2021 and 22 when companies were competing with stimmy checks, paying 20-somethings to also play video games in the basement. Meanwhile, a separate study from LinkedIn found entry-level hiring is down 17% since pre-COVID, with hardest hit being tech, finance, and marketing, which are all AI exposed, while healthcare and construction are holding up just fine. This all means recent grads are taking what they can get. Resume Builder found almost 40% of Gen Z college grads are working blue-collar or the trades. These are college grads, so they wasted the degree. Another study by Cengage found just 30% of recent grads found a job in their field, as in 70% of the degrees were wasted, 150K down the drain. Keep in mind, this is all with AI still in its early days, waiting to fix the hallucination problem before it deploys at scale in millions of companies. So as sex, if millennials thought they had it tough with 2008, they ain't seen nothing. Between the COVID hiring hangover and AI, we are in the early stages of a no-hire, no-fire economy where companies might hold on to older workers, but they are in a hiring strike for Gen Z. Deportations could buy us a couple years, assuming college grads are willing to take a real blue-collar job, and more help is on the way from the trillions of investment dollars Trump is bringing in trade deals, along with a Fed that just flipped to job-creating money printing at the expense of inflation down the line. Still, unless we make it much easier to create jobs and gigs, so less red tape, less employment tax, more startups, Gen Z is cooked. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite. maker of the famous block clock. CoinKite devices are made in Canada and they're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. We just got a double helping of 2 months of job numbers that beat market estimates. Even as the unemployment rate crept up, the underlying numbers were surprisingly strong, even as left-wing media, of course, painted it black. For CNN, it was, quote, troubling. MarketWatch called it tepid. Axios gave up and just called it confusing. On Tuesday, the Bureau of Labor Statistics reported job numbers for October and November. Now, usually they just give us 1 month. This time it was 2 because of the shutdown. By BLS's count, the economy lost 105,000 jobs in October and added just 64,000 in November, coming to a net loss of 41,000 jobs. Now, that sounds grim, but there are 2 very big caveats. First, federal workers made up all of the lost jobs. In fact, over the 2 months, federal workers lost 162,000 jobs, which is fantastic for taxpayers. And it means the headline loss of 41 turns into a gain of 121,000 real jobs. The other big one is deportation. So DHS has not announced exact numbers for October, November, but since Trump took office, deportations, including self-deportations as well as the old-fashioned kind, they've been running at about 250,000 per month, which is worth at least 100,000 jobs per month. In other words, BLS says we lost 41,000 jobs. Controlling for federal layoffs flips it to 121,000 gain, and controlling for deportations takes it to a 300,000 job gain. Even the rise in the unemployment rate is good news because it is not being driven by falling jobs. It is being driven by more Americans coming into the workforce, which they do when they think they can get a job. The key here is unemployment only counts people who are actively looking for work, sending resumes, going out for interviews. They're instead playing League of Legends in mom's basement or homeless in Philadelphia. They do not show up as unemployed. Statistically, they may as well be retired. It's only when they start looking for work that they show up as unemployed. According to the Household Survey, that's exactly what happened, with labor force participation rising by 3 ticks since July, which is nearly 1 million people coming into the workforce. So Americans gained 321,000 jobs, 1 million entered the workforce. If that is tepid, MarketWatch needs a dictionary. So for months now, the word of the day for media and the Federal Reserve has been the jobs slowdown. A slowdown driven entirely by federal layoffs and deportations, both of which mechanically reduce the number of jobs but are fantastic for American workers. Meanwhile, jobs are set to accelerate between an inflationary Fed and trillions of incoming investment that together could create millions of additional jobs. Put it together, and Trump's biggest vulnerability in the midterms is not jobs, it is the inflation that comes with fast growth when Congress is spending like drunk sailors with Dad's Amex Platinum. Prediction market Kalshi is currently forecasting a $600 billion rise in federal spending for the year, which is quite a change from the trillions in cuts Republicans in Congress pretended to support back in the Doge days of summer. That's enough to send inflation back over 3%, while the Fed and the media chase a job mirage. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersaintange.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.